Welcome to our quick explanation of one of the most fundamental metrics in investing, the PE ratio, or price-to-earnings ratio. Let's start with the basics and define what the PE ratio actually is and why it matters to investors. The PE ratio is one of the most common and widely used metrics investors rely on to evaluate a company's stock. PE is an acronym that simply stands for price to earnings. Understanding the formula is essential to grasping the PE ratio's significance in financial analysis. The PE ratio compares a company's current stock price to how much it earns per share. The calculation is straightforward. It's the stock price divided by the earnings per share. Now, let's explore what a high PE ratio suggests about a company and investor expectations. A higher PE means investors are willing to pay more for each dollar of the company's earnings. This can signal strong future growth expectations, but it could also mean the stock is potentially overvalued. Conversely, a low PE ratio sends a different message to the market. A lower PE ratio can often indicate that a stock is currently undervalued or cheap. However, it might also suggest to investors that the company's growth is expected to slow down. It's critical to remember that the PE ratio is not an absolute measure and requires context. PE ratios only provide meaningful insights when you compare companies operating within the same industry or sector. In conclusion, the PE ratio helps investors judge valuation, but remember, context always matters when making investment decisions.